Okay, we have an audience. Hello, welcome to this breakout session at the IETA's European Climate Summit. We're joined by, we have an oversupply of talent and an undersupply of time, 45 minutes to deal with this topic of the EU ETS and its outlook for the coming months. So we're going to jump straight in. But first of all, to introduce our panelists, I'm joined by Ingvild Storhus, who is the manager of EU carbon analysis at VATE, by Ben Lee, who's a senior carbon analyst at Energy Aspects, by Stefan Feutinger, who you all know probably from his appearances on LinkedIn, who is the head of market research and analysis at Virtus, Bernadette Papp, an old colleague and friend from Pact Capital, Alex Rao, general partner at Environmental Commodity Partners, and Lewis Unstead, senior analyst at ICIS. Welcome all. Thank you for joining us. It's been a bit of a roller coaster year so far in the EU ETS. We've had a 30% swing in prices. We've had the impact of the energy crisis from last year. We've had sharply lower emissions for 2023, reported 15.5% decline year on year last year. And early data from 2024 suggests that's not changing at all. So we're here to sort of stir the tea leaves a bit and take a look at how we think the market's going to evolve. And how maybe the European Union is going to respond to some of these events and some of these developments that we've seen. So I wanted sort of to look at, first of all, your takeaways from the verified emissions data from last year. What trends are we going to see continuing? What's the outlook for industry? Because that's the sort of the black box that we don't necessarily got a lot of good information about. Ben, start with you, if I may. You want to grab yourself a microphone. How does the verified data strike you, and what should we be looking at for this year?
Yeah, so I think the verified emissions numbers came in, showed a big drop that you mentioned, and that wasn't too much of a big surprise. Everyone was kind of expecting big drops in both power and industry, and we kind of saw that. I think this year we could see not so much continuation on the industry side. We've got things relatively flat on industry. Things should pick up, but on the power side, we expect another drop, not quite to the same extent as we saw in 2023, but with the ongoing build out of renewables, power load's still relatively low, nuclear looking a bit better this year. So putting all that together, I think we've got another drop, not quite to the same extent for power, but relatively flat for industry emissions, but still a relatively bearish picture on that front.
Okay, thank you. Bernadette, you've spent a lot of time closely linked to industry and to the buying aspect of the EU ETS. What do you hear from industry? I mean, are we seeing, as some people have said, deindustrialization following the energy crisis? How bad is that really at the moment?
Yes. Actually, I can just confirm what Ben was also mentioning. The outlook is still gloomy. So let me tell you two examples, practical side as usual from myself. Maybe 2 weeks ago, I spoke to a cement producer. They are producing sinks, for example, for bathrooms. And in the last year, for example, they were really suffering. And he was explaining me that due to the fact that interest rates were very high, construction of new apartment buildings, for example, slowed down significantly. And they simply didn't get new orders for their products. And the only positive point he can believe in at the moment is that central banks start lowering the interest rates, which will then filter down to mortgages as well, and then the construction sector picks up. But actually the same trend I can see, for example, among brick manufacturers in the region I live in. This is Hungary and the area around Budapest. Several brick companies simply stopped producing last year. They started filling up inventories in the first quarter of this year, but the recovery is slow, or rather neutral, I would say. So all in all, industrials are still in a wait-and-see mood. They have to see general economy, macroeconomy growing and improving in order to be more optimistic about their production levels and also about their emissions.
Great, thank you. So a gloomy picture on both the power and the industrial side there. Lewis, if I can just sort of throw forward again, we are now approaching the publication of the TNAC for 2023, and then to look at the MSR takeaway from the market. What are your expectations for that? Will it be the biggest yet, and how will the market react, do you think?
Yeah, so with the 2023 verified emissions now out, we can calculate what this TNAC is going to be. It's available from kind of the information that's out there. So we have that around 1.1 billion tons, which is a significant drop year on year. But interestingly, it's above this new upper threshold of the MSR, this 1096 million tons. So the intake from the MSR this year, or from September 24 through to August 25, is going to be kind of based on this 24% withdrawal still, not this buffered intake rate, which is quite significant. You know, we're going to get 260 million tons removed by the MSR over that 12-month period, around 88 million tons between September and December this year, and then 170 million tons between January and August next year. I don't think this comes as a surprise for the market, because we knew that the MSR was going to take in that surplus that was left from a lower emission trajectory over the last 2 years, but it provides a reality check. You know, we are in a moment where the market is fundamentally weak. You know, we're kind of talking to people at the conference and my fellow panelists, I think everyone's fairly bearish, but the MSR provides that reality check that it will work and it will tighten the balance in the midterm. And this is, you know, kind of maybe the first sort of turning points in that bearish view that could start to materialize and challenge ultimately this sentiment in the market. So not surprised, but more of a confirmation that future tightness is on the horizon. And yeah, this is the first time we're seeing this bearish emission trajectory of the last 2 years dealt with by the MSR.
Okay, thank you. Now, Alex, you've had the fundamental supply-demand scenario laid out in the last 3 interventions. Speaking as somebody who's in the market, how do you look at that, and what do you take away from that in terms of your view longer term?
Yeah, I mean, it's hard not to take that view of the fundamentals into view. So it depends on your time scale. So we, as a firm, have an ability to trade both short-term and long-term. And so clearly from the long-term perspective, the big question is, when does the market start to look through to the current period of ample supply, weak fundamentals on the demand side? And yes, I think there is, quite a consensus. It's certainly not a contrarian view that things should tighten again in a couple years' time. And so markets tend to discount that view of the future. And so the big question is, when do you see that discounting? And then how does that shape any potential bottoming that we see in price action? And so, of course, the price action in the near term is quite a bit more stochastic, I think, and quite a bit driven by a number of other influences. And I think in particular the correlation to gas prices and who's driving who in that conversation is, I mean, there's a lot of differing viewpoints there, but I think these are the things you sort of try to balance. Short-term fundamentals don't look good, even for the gas market. So that weighing out in terms of your view on the bottom, where we will see that from a timing perspective, how you would sort of try to take a view on volatility in the market turning around in a major channel. And I think volatility is clearly one of the main questions that, maybe even to be provocative a little bit, has been injected into the market by the MSR. So I think you can take a view that, historically prior to the MSR, we had, call it roughly 4 million tons a day of auction volumes. The MSR maybe dropped that in half for the last period operating since 2019. And we've seen the effect of that. And the effect, of course, played out right in the middle of a gas crisis and a major sort of energy crisis. But that volatility now is structurally here in the market. So will the REPowerEU additional volume, so we're back up to call it 3 million tons a day, is that a 50% watered down of the MSR effect while the REPowerEU volumes are still in play? I think that's the kind of framing that we like to think about in terms of the short term versus the midterm versus the long term, and that's how we would sort of take a view. And so the view is clearly, when do we discount through to those tighter, less auction volumes again? But in the near term, is it it's not 12 months, it's probably more like 18 months, and that's a long time in this market. So that's hard to avoid that perspective.
Thank you. Okay. Ingvild, we just heard 18 months worth of discounted prices, the MSR versus REPower being a big battle, if you like, for the hearts and minds of the fundamentals in the market. Is it working? Is MSR working? And has REPower just sort of pulled the rug from underneath it?
MSR has been working. It is working. Whether it will work in the future, I think we will kind of have another question on that in a few years' time. When things are really getting tight, and MSR is making a big impact due to the REPowerEU volumes and due to kind of answering to low demand in these years. So I think kind of that's up for discussion. For now, it has been, I mean, we can still say it has been the superhero of the EU ETS. It saved the EU ETS and brought confidence back. Whether that's true for the future, whether it's kind of properly rigged for the next years to come, that might kind of be up for discussion. But REPowerEU has definitely made things more troublesome for the EU ETS. The EU ETS is complex from before, and then adding complexity on top of that. I'm not sure if that's kind of what EU ETS needed.
Okay. Stefan, let's look at where we are today, look at the volatility that we're experiencing. What is driving, I mean, what drives the market on a daily basis in your view this year? Because we're in a different world now than we were, say, 18 months ago, pre-energy crisis, pre-COVID, all of that. We had a trajectory, we had a market that we thought we knew where it was going. And now, do we know that so well?
I'm going to say something quite controversial, and which is not good for my craft or our craft, probably as analysts. I think it's a very difficult year for carbon analysts to be right at all. And the reason is that carbon this year is a price taker, in my opinion, and not a price maker. When you have fundamental balance that is more or less flat, and you have ample fuel switch capacity, then really, carbon doesn't move anything. It's gas and it's power that moves something. Now, as humans, we always confuse cause and effect, right? So we might be looking at the clean dark spread, which is the profitability of a coal-powered asset, and say, oh, well, it's negative. So because of this, coal is not in the money, and that's bearish for carbon. But actually, it's the other way around. The clean dark spread is only the effect. It's the iteration between gas, power, and carbon. And really what that means is that if you look at the merit order and how power is priced, right, you have the main input factor, which is gas. Why? Because usually it's the gas-fired plant that sets the price. And other than that, the other input factor that you need is to understand what you discussed here a little bit, how much is the demand side? So where demand and supply, and power supply is also important, right? But where demand and supply on the power side meet, that's where the power price is going to be set. And why that's important is because, let's say in 2022 we had a big crisis on hydro, big crisis on French nuclear, so supply on the power side was really bad. And as a result, you had these fossil assets moving into the market, and because of that, emissions didn't drop in 2022. In 2023, that looked quite different because you had a stable power supply from French nuclear. You had also more or less stable nuclear hydro. But at the same time, you had this big drop in especially industrial demand for power. And because of that, we've seen the 24%-ish drop on the power side, not because of the carbon price, but really because fossil was priced out. So you basically have the clean dark spread that is only a function of the other ones. And it really, I mean, it's hard to say as a carbon analyst, but carbon really doesn't matter to the price of carbon. The only thing that really matters is the gas price and is where supply and demand on the power side are coming in. Let's say I'm a hedge fund and I am buying, or let's say I'm selling EUAs because I think this is bearish. What happens is if you have ample fuel switch capacity, so I'm selling, carbon gets cheaper. Because carbon gets cheaper, you have now more coal power that comes into the stack. More coal power means more demand for EUAs that moves up the prices, and I just got out of my trade and I made a deficit. Same trade on the other side if I'm going long as a hedge fund, and carbon price goes up, fuel switch happens, more gas, demand for carbon comes down, and again I got priced out and I made a loss on my trade. And I think because of that, the only reason where it would change is if we had fundamentals that are stronger, very bullish or very bearish, fundamentals that are stronger than actually the power market fundamentals. But we have this year more renewables pushing in, demand is not really picking up. So basically where that leaves us, in my opinion, is that it's really hard to make money actually on the carbon market, and it's really hard to forecast it correctly unless you have, and I think that's probably you're better than us on that, a really good forecast for gas and power. Because otherwise, as a trader, you cannot really make any money. The only way you can make money basically is if you have a better gas and power understanding than the rest of the market, and or if you're quicker than the utilities and you can arbitrage your way out of that.
Thank you. Lewis, do you agree with that? Is carbon a follower now and sort of in a vacuum in the short, medium term until we get a trend again?
I think I agree with Stefan's point here on the difficulty for this market to price in demand on this bearish trajectory. And I think that's been a challenge, and ultimately I think that's where it's put some of the selling pressure that we saw at the start of the year in the driving seat. You know, we were able to go to 60, then move towards 50 without kind of tranches of EUA demand coming in from the power sector, which typically has been that short-term flexible balancing agent in this market. And with limited fuel switch potential now, you know, as EUA prices move down, the only thing that you can do is maybe switch out 4.6 gigawatts of gas that's in the money for 4.6 gigawatts of coal for the front year. That's not much. It's not going to move the needle. And so I think this kind of, let's say price-taking behavior, I don't know if I would phrase it the same way, but it's a difficult dynamic, I think. And that's why we've seen this, say, price discovery mode for the EUA market over the last couple of weeks. And I think where the market is today, it's maybe to the opposite of where we were a couple of months ago. And I think therefore, you know, ultimately we're taking a kind of maintaining our bearish view, I would say, for the next couple of months.
Okay. We've been talking about how coal is out of the money, how gas is in the driving seat. Alex, from a trading perspective, are you now, instead of being an EUA trader, are you actually a gas trader?
I mean, effectively, yes. I mean, it's hard to avoid the fact that the correlation between gas and carbon is very strong. Questions about who's driving who, I mean, I don't take the view that carbon is really driving gas. I think gas is a much bigger market. If you look at the number of traders and the number of traders have grown in TTF in particular with the volatility that's come into the market in the last few years, I think that has brought in systems, that has brought in, you know, your macro traders, your quantamental, you know, type traders who really see it as a liquid energy index product that they can trade, and I think that has brought a lot of people to trade EUAs as well alongside that complex. That's probably not going to change, of course, as volatility dampens out of the gas market. I think a lot of the interest of the short-term traders may also abate a little bit, and so that's one of the questions you could see long-term about, you know, structural volatility in the overall EU complex, energy complex. I think we could see that start to bleed out a little bit because the crisis, you know, this is driven by the crisis and the tightness of the MSR into this market. So, but yes, if you try to ask the question, where is this going? I think the liquidity suggests that the correlation between the front month gas contract and EUAs is stronger than ever. And so that is even more of a question, like, why would that be the case? Why should that be justifiable fundamentally? It isn't. There's no, to my knowledge, no justification. I have been active in the market since 2013, and historically the correlation clearly was more to the calendar contracts, both power and gas, and that's clearly not the case anymore. That probably broke during the last, 2022, 2021, 22, 23, when you had such, the calendar contracts are so notionally large compared to the unit size of an EUA. So I think you get the sense that there was a shift in the liquidity for gas markets to the front months. That's certainly how the system's traded. So if you're talking about CTAs, you're talking about algorithms, and then of course, I think that's where you get a lot of the discretionary funds trading with the liquidity. So all of that has kind of piled into the front month on gas, and then has expressed that's more or less a similar sized contract to an EUA. And so to me, that correlation is coming from the market itself. It's not something fundamental. And so that doesn't, to me, that doesn't last long. That's as long as we have this excess liquidity, excess amount of trading in the EU energy markets, I think that's going to persist. And that would be a big indicator to watch is when that breaks, in my view. So.
All right, so we just have to be patient for that. Coming back to you, Ben, if I may. We've talked about how coal is being phased out, how we've had renewables coming in at a great pace and beginning to dominate the market. Carbon has always priced on the fuel switch up until now. What happens next? What do we look for as the next way to find what the price of carbon should be? Where do we look?
Yeah, good question. Yeah, it has historically priced on the fuel switch, and I think this was mentioned a second ago, but that fuel switch has become fundamentally a lot less relevant these days. When moving from one fuel switch trigger to the next, you only get a handful of million tons extra emissions, and that's really not much to really to drive things fundamentally. So I think going forward, when this market gets tight again, we're going to be looking at decarbonising industry and whatever price is needed to do that. So I think that's the next step that we head towards. But for the time being now, when balances aren't particularly tightening, and that isn't as much an issue, we're not quite there yet. But looking forward, that's where we're going to have to look, I think.
Okay. Bernadette, if I might, you again, going back to your experience with industry, do you have a sense of which sector might be the next one to be the price setter for carbon? Because if you look at cement, lime, bricks, paper, all those different sectors with wildly different input costs and what have you, which one strikes you as being the most relevant for setting carbon prices?
Again, I can tell a personal experience in this regard. In Q1, when prices were falling, we did a lot of recalculating, mainly because as project developers, we also try to help some companies to decarbonize and start these projects because we are using our network and experience with local governments and so on. And there have been companies already in the process of implementing new technologies, others considering those, and actually all the calculations that have been done last year, for example, or 2 years ago, had to be redone, and some of them were just thinking, okay, is it worth doing this project at all, or is it simply cheaper if I keep emitting and buy the allowances at 50-55 euros, because industrials need significantly higher carbon prices to make those investments profitable. So definitely right now, since let's say the second half of last week, they are more calmed down, but as the colleagues also mentioned, there are still lots of risks, lots of uncertainties if this price jump or increase that we have seen in the last couple of days is sustainable, because the fundamentals are not there yet. On the long run, of course, everybody is more optimistic, especially regarding the second half of the decade or the phase. But at the moment, there are some project reviews and planned reviews among the companies. We are in contact with cement companies, mainly from the Baltics, that are at different stages of decarbonization. Some of them are really scared now that all the money has been wasted if they have started the project already. Some of them are delaying their decisions. And among steel producers, actually the same experience we have. They still fight with cheap imports. And of course, they are also scared by the effect of the CBAM. So couple of risk factors for them to be taken into account in the future.
Okay, thank you. Before we gathered, Ingvild, we were planning this session, and you wanted to talk particularly about REPowerEU, and I think we are at a stage now where we can start to think about what will happen in the next year with the allocation for auctions. Can we bring the slide up that we brought? Is there someone back there who could put a slide up for us? Perhaps not. Yes.
Yes.
Take it away, Ingvild. Give us an explanation.
Yeah, REPowerEU. Of course, EU ETS has become quite an important revenue stream for EU as a whole, EU member states, for a lot of the funding that is needed to do the shift. And of course, when the war in Ukraine broke out and we had a REPowerEU plan, some of the funding was coming from the EU ETS. And I guess that's perfectly fine. I think the only problem for the ETS was that it was set to be a monetary target. And that means we don't know how much volumes will come to the market to fund or to reach the monetary target. We have in the auction regulation, we have the stipulated volumes from the Commission with a target price of 75. So the volumes that are coming to the market this year is based on the expectations of a 75 euro carbon price. Of course, we haven't seen an auction price of 75 euro this year. So the revenue so far is 22% lower than kind of being on track to meet the 2024 target, you could say. So this means that this revenue gap needs to be filled by more volumes to the market. We don't know when these volumes will be added to the market. In our base case, we believe that they will adjust the 2025 auction calendar. They might kind of also adjust the 2024 calendar, maybe with the readjustment of the MSR volumes, but we don't really know. And of course, if we see kind of, okay, we have the actual auction price for this year, then we expect kind of the volumes that will be added, that will be based on the actual auction price. So this will mean kind of next year, it will not be 89 million that is kind of coming to the market. It's 100 and something that will come to the market. And then if price is not the same as the average this year, we will reach the target sooner. So it's a big risk also for 2026, where we see kind of now it's stipulated 58 million tons. Of course, that will also be readjusted based on the actual price for this year. And then, of course, I mean, the auctions should go on really until, or kind of plan to go on until August, but it will stop once you reach the 20 billion target. So in our base case, based on our price forecast, we see that they reach kind of the monetary target already. It's only like required 12 million ton that is required in 2026. So that's kind of quite much less than the 58 in this, which is stipulated in the auction regulation as of now. So I think that's kind of a big uncertainty. And of course, these are only based on our assumptions. We have to take into account kind of what's actually the real price, and we don't know. And we don't know the timing, and we don't know the volumes, and we don't know when the auction will stop. So I think this is a kind of expectations that it will kind of bring more volumes to 2025 in a year where we really don't need any more auction supply. And then 2026, we potentially will have quite much less, or it's a risk that we will have less in a year that we see is quite short already. So I think kind of the REPowerEU brings uncertainty, and also kind of that's part of the picture for this year. I mean, we talked a lot about kind of drop in demand, but of course, with the price dropping, it's kind of always been focused about kind of how much more volume will come to the market because of REPowerEU.
Thank you. Stefan, you look at this as well. And if you look at that chart there, the amount to be auctioned in 2026 is relatively low compared to the revenue that it might bring in. Does that imply, do you think that it means that prices will start to jump sharply as we near the end of REPower?
I want to make one step back on this, because it's sometimes said that REPowerEU is basically a death spiral. You know, the lower the price, the more volume you need to bring in. And we don't think that death spiral is actually going to play out, because if the prices go too low, what the EU, in our opinion, can simply do is meet with the member states and say, hey, this is not good for us, we're all making less revenue. Let's just do what we did last year in 2023, and let's just earmark some of the allowances that you would anyways do. Let's earmark them as REPowerEU volumes, and we're all fine, because that way the market's going to calm down. I think that's what would be my default that they would do. The question is when, right? Right now the TNEC comes out, right now they need to discuss that and decide what to do about the volume. So we're with you here. We don't think that would change a lot this year. Also because you have elections going on, you probably are happy with a little bit of a lower price. I think it's just an option that you would take. It's like a card that you could play if things go bad, if things go really south with the price. So I'm not too worried about REPowerEU. And I do also want to get back to the point that you made earlier about where's carbon going to be priced. In my opinion, it's going to keep being priced by the utility sector as long as we have sufficient coal-fired power plants in the market, which is probably somewhere around 2026, 2027, I would guess, where we could see a shift when it is likely to then be priced more on the industrial side. Because the utility side is very interesting. There's still a lot of hedging going on, even though it has come down massively. But that, the example I made earlier about this shift is not just in real-time emissions, but the whole hedging curve plays a role here. So you have a lot of, volume coming in and out of the market, and that's why I think the speculators actually are not strong enough, unless Warren Buffett comes here and says we're going to buy all of this up, is not strong enough by itself to really move the market. So utilities are going to keep setting the price. In my opinion, at the clean dark spread is going to decide that. If you give me the perfect forecast for gas and for power, and I know the power demand and the power supply, I know exactly which coal asset is still needed to make the power we need, and then the price is going to be there. So that's relatively straightforward. It gets less straightforward when you talk about industry, because by and large, I would say CCS is probably going to be a key in deciding where the price goes, carbon capture and storage. But the prices for that are really, depending on where you do it, which technology, can range from, I guess, 90 to 150 or something like that. And also there's a time delay. So now we also spoke to a cement producer lately that had a plan to do a CCS project on the table. And they basically told us, and I think we are particularly bearish with our forecast, but they said, Stefan, if I show this to my board, there's no way we're going to do that. And so you have you probably have less action now because of the lower price, but it's going to spike even more because of that time delay.
Lewis, REPowerEU, we're behind at the moment. We're going to catch up a little bit next year. And do you think there's going to be this moment in 2026, late 2026, when we've reached the 20 billion and everyone goes, okay, now the market's going to be super tight and prices are going to take off?
Yeah, I think there's a turning point, right? And what we acknowledge now is that the way in which REPowerEU is designed is exaggerating this sort of market myopia, right? Bearish price developments correlate with increased uncertainty on the supply outlook. That's just the way in which the policy was designed. I agree with Stefan. I don't think this is the be-all and end-all of the market dynamics, but it's a reality that the market faces, and I think when we move to levels that we saw in February, 50 euros, this narrative will pop back up again, and it will be kind of this cyclical thing. What we haven't mentioned, I think, is if there was to be any additional volumes added to the REPowerEU schedule, which, like Ingrid said, we don't know, could be, could not be. If they were to be added, the MSR is going to be very, very powerful at this time and take out 100%, according to our forecast, of any additional supply. So yes, short-term bearishness is something that this could add to, but for us, actually, the long-term bullish case for additional volumes and the MSR impact is actually more important. And that would really kick in 26, 27. If you put more volume in next year, your MSR in that period is going to be very strong. And this is where we feel the bullish risk could come from, not from the REPowerEU ending, but this new volume. And I think maybe going back to a point on the fuel switching dynamics and the say, reduction in fuel switch potential, we're already seeing that now on the downside, okay? The EUA market is not able to price in additional demand. When we get to a market that's 150 million ton annual deficit, 26-27, and we need this short-term flexibility to balance the market, via reduced demand, the let's say the hedging demand and the CO2 price sensitivity of that demand is going to be a lot lower. So we see this upside risk in 2026 being fairly large, through to 27 as well, because of this fuel switch potential reduces at a faster rate than industry abatement begins to materialize. And this is the risk that we see in the midterm. We talk about when is that going to be priced into this market. I think not for this year, but it's definitely a theme that will come up in 25. But yeah, the REPowerEU package is going to continue providing us questions to be answered, I think, for the next couple of months.
Alex, you're hearing all of this. It sounds like there will come a moment when fundamentals come back into play and when we can actually look at supply and demand. How does that sound to you? I mean, looking at this chart, looking at REPower's schedule, getting there in 2026 perhaps, and suddenly the market suddenly goes from being additionally supplied with REPower to having lost the net reduction of that supply. How do you face that as a trader? What do you?
Well, I think the first point of view I'd give is that I actually think it's healthy that the market is showing some pricing discipline compared to the previous couple of years, where clearly it was a crisis scenario, and so everything breaks in a crisis scenario. So I grant that. But now to see and I would attribute this actually a lot to the REPowerEU volumes on top of demand destruction, is that you are seeing the reflection of fundamentals. So I think that's a positive thing for the market. It's showing the right way. And so from that perspective, I actually I totally agree. I discount the doom loop narrative of the REPowerEU structure, and I also think it's actually suited the market quite well for the time that we're in. You can also ask, when fuel switching is broken, the spreads are negative. They're, looking back to 2022 or 2023, when there's no gas to switch to, what is the point of an EUA price continuing to be higher and higher and higher? It's not having the fuel switching impact. So to me, this is a positive thing that we're seeing fundamentals a little bit sort of, or market discipline, call it, reasserted on both the short run. So then the long run, and I do attribute that again to an increase in auction volumes in a significant way. So to me, if you look at the MSR withdrawal rate of 24%, that now in retrospect, that is very strong. And it clearly was a mechanism to deal with cumulative oversupply, but it did so by essentially artificially tightening the available supply in the market tomorrow, or in the next week or the next month. And so by haircutting auction volumes by 24% of the oversupply a year, is that the right mechanism? I'm not sure. So REPowerEU essentially watering that down a little bit in the middle of a broken kind of fuel switching equation and a crisis environment, I think that's positive. So to me, it actually is encouraging for then, okay, now the REPowerEU will phase out eventually. I discount the doom loop narrative like all the panelists here. So at that point, then the market tightens again. We are living with a 24% MSR withdrawal rate from 2026 onwards. So that's going to be tight, and that suggests that the fundamentals will justify that at the point. So that's kind of how I would sort of give it, and that just says if you're trading the short term, you got to trade the short term, and you got to trade gas, right? If you're trading for a mid or a longer term perspective, either as a thematic investor like ourselves, or clearly as a compliance entity which is able to take a strategic or a longer term view, I think you see the answer right in front of you. You see where value is going to go. And I think the price action in the near term is actually reflecting a little bit more of the short-term fundamentals, so that's positive.
Okay, so patience will be rewarded. We have a few minutes left. If anybody would like to jump in with some questions, we have a couple of microphones roving around the audience, so please make sure to let us know who you are and who you represent. Up in the middle there. Mark, yes. Right there.
Thank you, Mark Lewis from Andran Capital. I mean, what I take away from this panel discussion is we're in no man's land price-wise. The power sector has basically retreated. The power sector has been responsible for price formation ever since the inception of this market, and they're no longer in the market. The spreads even for winter are telling you that we don't really need much coal or gas-fired power. So they don't need to hedge, and they're not hedging. They're hedging much less than they have done in the past. So the key driver of price formation is no longer there, and the industrials who will have to take the baton, as it were, in the future are not playing. Bernadette has made that very clear. You know, there's just the replacement demand on a fundamental basis from industrial sector is not there yet. So we're in no man's land, and that's why the price can move 55 euros in 3 months. You know, we went down 30 euros to 51 from the beginning of the year. We've gone back up 25 euros nearly. I mean, 55 euros where the fundamentals have only got worse. So I think what's missing from the discussion is we haven't talked about positioning, COT data, and the extent to which that has become the main driver of price formation. Because if you don't have fundamentals driving it, it's a vacuum, and nature and the carbon market abhor a vacuum, and this is why you have prices bouncing around. So until there's a fundamental source of demand, I think this is where we are. We're in no man's land, really.
Okay, a right of reply to anybody? Alex?
Yeah, thanks, Mark. I take that point very well, and I agree on trader positioning. It's another theme I would give for the discussion here is that I think the market as a whole probably has sort of overfitted the last few years, if you want to use that language from, you know, how a system thinks. You're training on historical data and price action, and therefore, you know, you're only as good as your how far back you're going. And so something like the commitment of trader data is a perfect example of that. We only have that back to 2018. And so yes, you can see that happens to coincide with the MSR regime, right? So where this market has been very, very tight on an available supply basis, and therefore you can see dynamics, in my view, like, okay, you know, investment funds, whoever you want to call that, taking on record shorts, is a catalyst for then a different type of trader to come in and squeeze that. And so that is something that is in there. To me, it's a reflection of an artificially tight market in the near term. But what that does give you is this sense of, okay, that's the back test back to 2018, but this market has been around since 2005. And you know, no one's talking about what were the record shorts in 2011 or 2012 or 2013. So one of the lessons I very much take to that is that the short-term price action is driven almost market-wide by a systematic kind of hive mind that has a very short back test. And it's new entrants to the market, it's systems, it's kind of this algorithmic approach that is acting on a very limited history, and that coincides with the MSR regime. So I don't think the market has the ability to see beyond that, because that's just the way it's been trading, and that's a fundamental failure of the market. So.
Stefan, you looked like you wanted to jump in there.
Yeah, I do and I don't, because you know, being up in an argument against Mark, you can only lose. But I do believe that hedge funds, it's very easy to basically say hedge funds are moving the market. I don't think they are. I think they're just the smart money. They're a bit faster, but all they're doing is trying to understand gas and power better, and as a result, price in carbon. I think that's what we're also seeing. They've been very short, and probably the latest data that comes out today or has come out, I don't know if it has, will show us that they're out of the market.
No change.
No change. Interesting. Yes. Okay. We should go into the reasons behind that. But they had a very strong short position a few weeks ago, and that has then changed. So I don't think they are really behind it just because they're not strong enough. Yes, there's much less hedging going on now than it has been, but the power market is still the only one where you see significant levels of hedging, and that can happen very quickly. So in my opinion, the funds have, I don't know, a net short position then of maybe 25 million. I don't know if I trust that data, because there's probably the spreads and options, there's a lot in there. But I don't think that's really market moving in a sideways market. I really think that we still have the question of what is the power sector doing, especially hedging. And coming back to the point on the MSR earlier, I think yes, the MSR is strong, and it helped set the price quite a bit. But if we don't have hedging anymore from the utilities, and you have a threshold of 833 million, who's going to buy that stuff at some point? I know, when including us, when we do those fundamental balances, we say, okay, well, the long term is very bullish, very tight. I think we could be surprised how long it really takes until we see the tightness.
Thank you. Room for one more
question. Could I just do a quick follow-up on that, Ali? I mean, Mike's right next to me. He'll get the last word. But okay. If you think about power output Q1 this year versus Q1 last year and Q1 the year before, we're down 20% in terms of emissions Q1 24 versus Q1 23 for the power sector. And that means we're down 40% versus Q1 22. So if anything, at the moment, utilities are unwinding hedges. They've gone into this quarter over-hedged. And so I think that is an underappreciated factor. And I think the other thing, Q1 is always the strongest quarter for power generation. So for this year as a whole, you're never going to get back to power emissions rising year on year. They're going to go down again for a second consecutive year. I mean, this may be the new normal.
And can I get back to that one as well?
Yeah, go on.
And that's the reason why we probably had, 40 million less emissions just in Q1 compared to last year. 40 million, and then we have hedge fund net positions of, 25 million. So that's why I think it's insignificant.
Mike, go ahead.
Hi, Mike Szabo from Carbon Pulse. I want to look past all of this. I want to look past REPower and everything. Phase 5. How much are you guys looking at that? Are you starting to look at it? Are you doing any modeling for it? Are you making any assumptions? For example, a link with ETS 2, international offsets, changes to the cap trajectory, or are you kind of on standby at this point, waiting for the election, parliament elections, new commission, et cetera, see what happens to close out phase 4? Thanks.
Okay, we'll start here, Ingvild, with you, and just go all the way along the line.
We have started, and it's always fun to play around with, for instance, linkage between ETS 1, ETS 2. We don't necessarily believe kind of in a fast link between the two systems, because we have done modeling on ETS 2. I mean, also kind of looking at the abatement for long-term for industry, because that will be kind of the key sector, I would say, together with, shipping. But we see also kind of the abatement in industry is going to be so dependent, for instance, on power price, how kind of the abatement, how abatement curves are shifting with dependency on electricity prices. And of course, then kind of the need to fill the gap with removals. And then, of course, we're kind of looking into removals to see kind of a bit on the supply side there, see if it's able to ramp up to the scale as the Commission proposes. And of course, kind of we're also seeing kind of we will do also a scenario where they will allow for international credits as well, because now we kind of put all the eggs in one basket or two baskets with like removals or kind of industry abatement. You see also kind of the need of this massive build out of power capacity to meet the emission targets within all the sectors. That's ETS 1, ETS 2. So it's a lot of pieces in the puzzle that we play around with. So we have started, but we're not kind of done.
Thank you. Ben, are you looking at it?
Yes, we are. So yeah, we've got balances out to 2040, and lots of uncertainties in terms of what gets plugged into those balances at this point, just given how far away it is, and some of the rules are uncertain at this point. But I think the general story is, what's happening with the cap. A couple of scenarios where that could go. We're assuming that the cap probably follows something like a 95% reduction trajectory by 2040, and that does mean there'll be a cap of around 100 million tons by 2040, but there'll still be multiple times that emissions by that point in our balances. So it's going to be one where removals are going to be needed in the future for this market's kind of balance, I think, and it's looking very tight with gas-fired generation still running to plug some of the gap despite renewables. So yeah, I think it's one where we're going to need high prices to abate in industry, but even then it's potentially still not going to be enough.
Thank Thank you. Stefan?
We don't have anything on 2040.
Bernadette?
I have the same question as Stefan, but I would like to elaborate a little bit more, if I may. So when you asked before what is moving prices currently, my simplest answer is uncertainty or a risk matrix that we are experiencing in the market. So if we just look at the poll you published this morning, I think most of us would have done better not reviewing our previous forecast. So things are changing very, very quickly. Something that I'm still waiting for in order to update my model is rules of free allocation. So I think this is something that we have not mentioned until now, but industrials are very keen to know their free allocation for this year and of course for the second half of the phase when the rules, the numbers, benchmarks will be reviewed again. So this will be something again critical in order to define their hedging strategies or their trading strategies in the future. They changed their mentality compared to phase 3, for example. So they are really looking into the second half of the phase already, and they start preparing. So free allocation is definitely one critical topic that we have to see. On the supply side, again, the REPowerEU supply. And last but not least, we have seen many comments, mainly negative comments regarding CBM. From the industrial side, they are missing the compensation for exports. So who knows when the CBM rules are reviewed in the second half of the phase, if they get any compensation or not, that might affect the supply and demand side of the market. So we are still waiting a little bit in order to provide any forecast for phase 5 or anything further.
Okay, thank you. Alex, does your horizon stretch out that far?
No, it doesn't. No, continuity is important. So to know that there's no end, and your balances do carry over, but no, price action post 2030 is too far off.
Okay, Lewis, wrap it all up for us.
I think it's important not to forget that we're struggling to price in 2030 ambition right now. So thinking about 2040 is challenging from a short-term kind of trading perspective. And we saw the communication from the Commission on the 2040 target. This was really a non-event for the EUA market. No new price signals came from that. And I think for us, the point that will be interesting for the EUA market is when we get this 2040 policy package, similar to the Fit for 55 measures, where the ETS directive is being opened up again and reviewed for the post-2030 framework. For me, the MSR review is really a critical part of that in terms of what's going to happen to the parameters there. What happens to CBAM? Is it going to be extended to more sectors? And kind of on the point of free allocation, how does the longer-term trajectory look for that? And then on the cap, I feel like this is one that's often more tangible. We can look at it post-2030 already, but for me, it's not the most interesting point. I feel like the outcome's fairly binary. Either we maintain the 4.4% LRF, we reach zero near 2040, or we find, say, a more conservative reduction. There's a bit more carbon budget left for the ETS in the target scenario, and we can maybe, our modeling, we see kind of 120 million ton cap possible in the ETS by 2030, 2040, that's a 3.5% LRF, but we need ambition in the non-ETS sectors for that to happen, and therefore the 2040 discussion is not just about ETS, of course, but it's about the other sectors as well. But I'll leave it there. Thank you.
That's a story for another day. Thank you all very much for sharing your thoughts with us. Thank you all for sticking around for the extra 10 minutes that we took. Please join me in thanking our panelists, and let's go to lunch.